Overpayments on mortgages. Is it worth it? Is it not? Should you put yourself out? Hi, my name's Manda Walker and I'm the mortgage coach. And today we're going to be talking about overpayments. Now, I always encourage my clients to make overpayments. And what that means is a lot of mortgage offers, a lot of mortgages, when you're paying the mortgage, you can actually make overpayments to reduce how much that you owe at the end of the year or at the end of the term. Now, what does that look like? What does that mean? So basically, when you're looking at a mortgage, normally, like for a residential, for instance, you are borrowing, say, £100,000, and because of your interest rate, maybe you're paying £30,000 of interest. Now, that is added together, and when you're paying your monthly payment, say, of 1,300, a portion of that money goes towards paying the capital, and a portion of it goes to paying the interest. Now, at the very beginning of the mortgage, two things can happen. What will either happen is the mortgage lender will look at the capital and then they'll add the interest on, and that is how much the amount outstanding is. And basically what happens is every single month you will chip away at this, and then at the end of the 5 years you've paid 5 years worth of, say, the 25 years worth of interest. Then you go and remortgage, and you can look at changing the deal, changing the interest rate and everything like that. Now, there are other mortgages where you can pay the capital, so it's called making either a lump sum capital payment, or when you're making overpayments, asking it to be put against the capital, and then the interest, instead of calculating it as a set amount right at the beginning and saying, because of the term that you've picked and everything, this is how much interest you'll be paying. But what they do is they actually calculate it every single month. So what they do is, say you owe 100,000 and you pay £1,000 off that month, then they recalculate it and they calculate the interest not on 100,000 but on 99,000, and then the following month on 98,000, and the following month on 97,000. Now, basically, this is how credit cards work. They always calculate the interest on the balance. Now, some mortgages do work like this and some don't. So you really need to have an understanding when you're speaking to your lender what it means when it says you can make overpayments. Now, another scenario is you could actually make overpayments that go towards you having payment holidays. So, for instance, if you're meant to pay 1,300 a month, and instead of paying that, you pay, say, £2,000. So you're paying 700 more than the 1,300 that you should be paying. Then the following month, you pay an extra 7,000 again. Because you've done that, you've actually, in essence, paid an extra 700 plus 700 is 1,400. You've actually paid an extra 1,400. As your monthly payment is only 1,300, if you decided to get a payment holiday, i.e. not pay your mortgage for a month, because you've banked that money, you wouldn't get charged additional interest, you wouldn't get charged additional penalties because of that. So that is also an option that you can do. Now, basically, when you're looking at deciding what you want to do, a lot of mortgage offers say you can pay off 10% of the annual. So based on what the annual amount is, take 10% of that, and then you can pay that off and not have to pay early repayment charges. Now, what early repayment charges are, when you actually are thinking of paying off your mortgage. Now, this is different to if you're moving house. Basically, if you decide that you're going to pay down your mortgage, or, you win the lottery and you decide, I'm paying off my mortgage, based on how far into your mortgage you are. So say you're on a 5-year fixed, you may have to pay, within that first year, you may have to pay 5% of what's left outstanding. If you've got 4 years left, you may have to pay 4%, 3 years left 3%, 2 years 2%, and 1 year 1%. Now, some mortgages will be based like that, and they will have a stepping stone and it will go down. This was just an illustration. They're not, every single mortgage out there isn't a 5, 4, 3, 2, 1 scenario. Some of them are at 5%, and then it's at 3%, and then it's at 1% for quite a few years, you know, the last couple of years. And if it's a 2-year fixed mortgage, maybe, you know, it's at 5%, 3%, and then zero because, you know, you've done those 2 years. So that is also a scenario. But basically, when you're looking, the most important thing is read your mortgage offer, because that gives you all this information. I mean, there's even lenders out there that don't actually stagger it at all. So literally, if you're on a 5-year fixed, you have to stay there for the whole 5 years, or you're going to have to pay penalties. You might have the 10% overpayment option, but that is pretty much it. You cannot make any other payments higher than that, because you will, you know, reap charges. So what I would suggest is, if you get a pay rise, or if you have more money than you realised, put in a savings account, an ISA, or basically we'll be doing a video about savings accounts and a quick way to save your deposit. But this will be the same principle. You find the best way to keep your surplus money, and then when you're ready to remortgage, what you do is, instead of remortgaging the outstanding balance that's, say, you know, 75,000 at that point, you would say you've saved up 25,000. Then when you go to remortgage, you just explain that you've got more deposit to put. So you've got your equity, which obviously is what the property is worth plus what the balance is, but then you've got extra savings on top of that. So then you could be remortgaging and at 50,000 rather than at the 75, because you're using those savings. So if there are early repayment charges, then that is what I would recommend. Put the money aside every single month, and then make sure you can do that. There are other mortgages called offset mortgages, which means you can have money in a savings account with the same bank and money in the mortgage, and have an outstanding mortgage. And the way it works is, if you've got 25,000 in savings and you've got 100,000 mortgage, your mortgage interest will be charged on the 75, the difference between the two, because you've actually got positive savings and then obviously a negative balance, mortgage balance, and that's how that works. So sometimes, if you don't want to make the overpayments, but you want the benefit of having you know, a lower mortgage amount, then you can save within the same lender. And the advantages to that is that you get the flexibility if you need to take the money out because it hasn't gone anywhere. Once you've made an overpayment on your mortgage, you can't ask for it back. You can ask for payment holidays, which I've explained before, but you can't ask for the money back. You can't say, oh, I've just put £50,000 to pay off my mortgage, but something's come up and I need 5,000. They won't give it to you. So you really need to be 100% sure that is what you want to do. So that's very important. Discuss with your mortgage broker how it actually works, because you know, originally the majority of mortgages were based on either daily, monthly or annual interest calculations. And what would happen is, if you paid every single month, it would calculate what the outstanding balance is, and it would calculate the interest based on the outstanding balance. So, you know, if you paid, say, the 10th of the month and you've got 20 days left, then for those 20 days you'd be paying a lower balance than the first 10 days, and vice versa if it was more towards the end of the month. So it is really useful to understand how it works and understand what that lender is allowing you to do and not to do. There's also a situation where sometimes you can opt to pay your mortgage not monthly but 4 weekly. I had a client and they were actually paid every 4 weeks, not every month. So they asked if they could pay their mortgage off every 4 weeks rather than every month, because they get paid every 4 weeks. Now, as you know, there are 12 months in a year, but there are 52 weeks in the year, 12 months in the year. But when you're actually, so 12 months would be 12 payments. But because you're doing it every 4 weeks rather than every month, then you'll be making 13 payments rather than 12. And by doing that, you do reduce your balance quite significantly. Now, there are a lot of calculators out there that show if you make overpayments, how it can reduce. But you need to double check with the lender whether they actually work that way. It's not as straightforward as you make an overpayment, they calculate the interest again, and that's what we're paying. It's not as straightforward as that, as I've explained now. There are different ways of doing it. So check with your lender. And if you don't quite understand, check with your mortgage broker. If your mortgage broker isn't 100% sure, they know about the 10% overpayment, but they don't know how that 10% is allocated, get them to find out. It's there working for you, so you can ask them the question. Thank you, and have a good evening.